Welcome back to Smart Stock Sam, the channel where data does the talking, the charts do not lie, and every setup is grounded in real numbers, not hype. Today, we are breaking down DataVault AI, ticker DVLT, a micro-cap sitting on one of the most explosive setups I have seen in this entire market cycle. With earnings dropping tomorrow, a short squeeze building like a pressure cooker ready to blow, and a legal catalyst that is literally unlocking suppressed value as we speak, the next 48 hours could define this stock for months, maybe longer. Is this the rare convergence that sends DVLT from pennies to dollars? Could this be the kind of setup that institutional players quietly position in while retail investors are still asleep? Stay locked in, because by the end of this video, you will know exactly what to watch, exactly when to act, and exactly where the risk lives. Now, before we get into the micro details of the chart, let us zoom out and understand why the smart money is paying attention to this name right now. The bull case for DVLT is not built on a single catalyst. It is a multi-layered fundamental shift happening all at once. Management has completely re-rated their revenue guidance, jumping from a $40 million target in 2025 to a massive $200 million for 2026. That is not a revision, that is a reinvention. On top of that, Wall Street analysts have slapped a consensus price target of $4.08 on this stock. With shares currently trading in the 80 to 90 cent range, we are talking about over 400% of upside sitting on the table, according to the analysts who cover this name professionally. And when you pair those numbers with the institutional accumulation data we are going to talk about in just a moment, the picture becomes very hard to ignore. This is not noise. This is a thesis. But here is the thing about a thesis. It only means something if the market validates it in real time. So let us talk about what actually happened this past week, because it is remarkable. On March 14th, the analysis identified a structural price floor sitting between 64 cents and 67 cents. Fast forward to March 16th, the stock bottomed at precisely 64 cents and 33 hundredths of a cent before institutional buyers stepped in and defended that level like a fortress. Not close to the floor, not near the floor, exactly at the floor. Then the analysis pinpointed 78 cents as the critical 50-day moving average reclaim level. On March 17th, the stock tested exactly 78 cents and 21 hundredths of a cent. A break above 80 cents was called as the trigger to open the path toward $1, and in after-hours trading, DVLT surged all the way to 90 cents. That is not coincidence. That is a total validation of the technical structure, and it means the framework we are working with is locked in and functioning. Now, let us walk through the micro timeline, because the sequence of this price action tells a very specific story. On March 16th, we saw what I call the defensive stand. The stock closed up 3.4%, but on volume, that was down 71% from its average. That is the quiet before the storm. Low-volume defense of a key floor is one of the most bullish signals you can observe, because it tells you there are no motivated sellers at that level. Nobody panic sold, nobody dumped shares. The floor held on almost no supply. Then March 17th arrived, and the bullish breakout exploded onto the scene. Volume came in at over 45 million shares. The stock reclaimed its 5-day, 10-day, and 20-day moving averages in a single session. And then, after the close, it surged 15.8% in after-hours trading. Momentum is not just growing, it is accelerating, and it is doing so on the kind of volume that gets institutions paying attention. Speaking of institutions, here is where the story gets really interesting. If you want to know where a stock is going, you follow the smart money. And the smart money has been quietly, methodically loading up on DVLT ahead of this breakout. Vanguard increased their position by 2,900%. State Street is up 2,800%. And BlackRock, the largest asset manager on the planet, raised their stake by 3,000%. Think about that number for a second. 3,000%. These are not traders chasing a chart. These are long-duration institutional allocators who do months of due diligence before a single dollar moves. When Vanguard, State Street, and BlackRock are all buying the same microcap stock before a breakout, they are not looking for a quick 10% flip. They are positioning for a structural re-rating, and that is exactly what the revenue data supports. Let us look at the numbers. In 2024, DVLT was operating at a baseline profile, a small, relatively quiet data infrastructure company. For 2025, management revised their guidance to between $38 and $40 million in revenue. That represents a 1,300% year-over-year increase. But the real kicker, the number that has analysts pounding the table, is the 2026 target of $200 million. This kind of hypergrowth scaling does not happen without real contracts, real infrastructure, and real institutional confidence behind it. The revenue re-rating is the structural backbone that gives every technical signal we are seeing on the charts a legitimate reason to exist. Price follows fundamentals, and the fundamentals here are pointing straight up. Which brings us to the valuation gap. Wall Street is looking at DVLT right now and seeing a massive mispricing. Shares are trading between 80 cents and 90 cents. The consensus analyst price target is $4.08. Even the more conservative estimates, like Maxim Group's $4 buy rating, represent over 400% upside from current levels. When you have multiple independent analysts converging on a target that is 4 times the current price, the question becomes not whether the stock gets there, but what the catalyst is that closes the gap. And on March 13th, that catalyst was revealed. A lawsuit was unsealed that changed the entire picture for DVLT. According to the filing, 96 million shares were allegedly misappropriated and sold illegally on the open market through an entity called Scilex. This created what is known as artificial compression. The stock price was being held down by unauthorized selling pressure that had absolutely nothing to do with legitimate market dynamics or the actual fundamental value of the company. Think about that. The stock was trading at suppressed levels not because of weak business fundamentals, but because of alleged illegal activity artificially flooding the market with shares. Now that the lawsuit is unsealed, now that it is public record, and those illegal sales are being halted, that dead weight is being removed from the stock. The ceiling that was never supposed to be there is finally coming off. And when artificial compression is removed from a fundamentally strong, high-growth company, the resulting price discovery can be violent, fast, and unforgiving for anyone caught on the wrong side. Now stack that legal catalyst on top of the short squeeze mechanics, and you have a situation that could move very quickly. Right now, 26.02% of the float is sold short. That is nearly 85 million shares that must be bought back at some point. Buyers who have no choice. The borrow fee is sitting at 21.37%, with peaks as high as 32%. With 3.64 days to cover, shorts are effectively trapped. They cannot exit their positions instantly without driving the price into the stratosphere. If tomorrow's earnings deliver a positive surprise, the resulting margin call scramble could compress weeks of price discovery into hours. And those earnings are coming tomorrow, March 19th. Analysts are expecting $24.7 million in Q4 revenue, but before we even get there, today, March 18th, we have the Federal Reserve rate decision, where any dovish signal could send risk assets surging across the board, providing a powerful macro tailwind for exactly the kind of high beta, high momentum setup we are looking at here. Beyond earnings, we also have the debut of tokenized legacy and the $5 billion Project Kestrel data center fleet on the operational catalyst horizon. The pipeline is full. The next 48 hours are dense with potential triggers. So how do you actually trade this? There are 2 clean setups. Setup A is the gap and go, the anticipatory play. If that 90-cent after-hours move holds into the open, you are looking for an entry on early morning pullbacks in the 85 to 90-cent range. First target is $1.00, a level that fills the gap and satisfies the psychological NASDAQ compliance threshold. Strict stop loss sits at 77 cents to protect capital in case the move fades. Setup B is the verification trade, the buy the news strategy. This only activates if management beats the $24.7 million Q4 estimate and reaffirms the $200 million 2026 target. You want to see a high-volume break above $1.05. From there, the primary target is $1.45, a major historical resistance zone, with an ultimate target locked on that $4 analyst consensus. Setup A is anticipatory. You are riding the FOMO and the short covering panic. Setup B is confirmed. You are trading the institutional re-rating. Both have defined triggers, defined targets, and defined risk levels. Know your setup before you press the button. Now, I would be doing you a disservice if I did not address the risks head-on, because objectivity is what separates analysis from cheerleading. And at Smart Stock Sam, we always show you both sides of the trade. The RSI is currently sitting at 70.97. That is critically overbought territory, and a consolidation around the $1 level is highly probable before any sustained continuation higher. There is also what I call the guidance trap. If Q4 revenues have been partially deferred into 2026 reporting periods, the market could react with an algorithmic sell the news drop even on surface-level solid numbers. Earnings beats do not always equal green candles in the short term, and microcap stocks are especially susceptible to sharp algorithmic reversals on any hint of a miss. And if we fail to hold 77 cents on any pullback, expect a full reversion back to the 64-cent structural floor, eyes open on both sides of the trade at all times. Before we wrap up, a brief but important note. Nothing in this video is financial advice. All content on SmartStock Sam is strictly for educational and informational purposes only. I am not a licensed financial advisor, and nothing discussed here should be taken as a recommendation to buy or sell any security. Always do your own research, understand your personal risk tolerance, and consult a qualified financial professional before making any investment decisions. Markets involve substantial risk, and you can lose money. Everything converges in the next 48 hours. You have 26% short interest providing the fuel. You have the $4 analyst target providing the gravitational pull. You have the Scilex lawsuit actively removing the artificial ceiling that was holding this stock down. And you have earnings tomorrow that could act as the match that lights this entire setup on fire and forces short sellers to cover all at once. The battleground is the 80 cent to $1 range. A clean, sustained hold of 80 cents through tomorrow's earnings makes a technical run to $1.45, the highest probability outcome. The spring is coiled. Now we wait for the release. Here is the question I want you to think about and drop in the comments. Do you think DVLT beats the $24.7 million estimate tomorrow and reaffirms that $200 million 2026 target, or do we get a delay that triggers the sell the news algorithmic drop? Let me know your read below. I read every single comment. If this breakdown gave you an edge or opened your eyes to a setup you were not watching, hit that like button and subscribe to Smart Stock Sam so you never miss another data-driven analysis like this one. And if you want to help this video rank, go tap the hype button on YouTube and let the algorithm know that retail investors are paying attention. We will see you in the next one. Next.